Hi, everyone. Welcome to episode number 55 of the Atlas Annuity podcast. My name is Marty Becker. I'm the owner and founder of Atlas Financial Strategies in St. Louis, Missouri, where we specialize in safe money retirement strategies. So in today's episode, I'm going to address an objection that I used to hear quite a bit, and then I didn't hear it for a long time, and now I've heard it a couple times in the past month or so. So I thought I would just go ahead and address it and teach you how to think about this in a financial mindset. The concern that has been brought up a couple times is that the annuity company is just giving me my money back, meaning we're sending them a lump sum, and in return, we're just getting a bunch of small checks. I want to start this with a quote that I think I heard from Mark Cuban originally. Regardless, it was someone very, very wealthy who knows a lot about money. And the quote goes, "I'm less concerned about the return on my money than I am with the return of my money." You see, because we've all been conditioned throughout our working years to chase interest rates. That's what we've been conditioned to do through the accumulation phase of our lives. And when you have a steady income from a job or a business, that's totally fine because you can sustain the ups and downs of the market. Nobody likes to lose money, but okay, if you do while you're working, it's okay because you have time to let that money rebound. But once you're retired and that income gets shut off, now you're in the decumulation phase, and riding the ups and downs of the market gets a bit more challenging. Because if you're pulling money out of an account that is also losing value at the same time, basically what you're doing is you're stealing the seed that is always planted the next harvest, and that is how people run out of money in retirement. And dealing with that challenge after you retire, that's what's known as the sequence of returns risk. And that is the very first thing that an income annuity is going to protect you from. The next thing the income annuity will protect you from is what's called interest rate risk or reinvestment risk, because most advisors are going to have your safe money holdings in bonds or CDs or dividend paying stocks, which is all fine to help provide income for you. And yes, those things will preserve the principal in theory, but what happens when the term runs out and if we drop back down to 0% interest rates? Because if that happens, you won't be able to get anything near what you're getting as of right now in 2024 to provide the income that you need and protect the principal. The next thing the annuity will protect you from is longevity risk. People get life insurance in their younger years to protect their family in case of an early death. An income annuity is insurance to protect you and your family in case you live too long. And always remember that annuities are insurance, they are not an investment. And because they are not an investment, the returns and the income are not based on what the market does. The income is based on risk pooling, mortality credits, and the law of averages and large numbers. So we are transferring all these risks from you to an insurance company. And the last thing the income annuity will help protect you from is what's known as withdrawal rate risk, meaning, are you pulling too much money out of your portfolio? And if you don't remember what the safe withdrawal rates are from any of my previous videos, I went ahead and put the chart up here again. So if you're listening to this on Apple or Spotify, when you have a chance, go back to YouTube and pull this up. So if you're 65 right now and you want a foolproof withdrawal rate to make sure that your money's going to last you 30 or 35 years, you're looking at about 3.5%. So for every $100,000 that you have, you should really only be drawing about $3,500 per year to start in your first year of retirement. So the annuity will allow you to spend more money because the payout rate is always going to be higher than what you can safely withdraw from your retirement portfolio. Because your portfolio is only going to go one of two ways. It's either going to go down or it's going to go up. And if it goes down, this is why we've had these withdrawal rates since about the early 90s, going back to that 4% rule. Or the portfolio is going to go up, which is great, but that doesn't mean you can start taking more money out of it because we don't know what's going to happen in the future. So that's why advisors tell you to stick within these withdrawal rates every year. And the problem, if you want to call it that, with your portfolio going up and up, what could happen is you could just end up with all kinds of additional money in your 80s or 90s that you never intended to have and you never had the opportunity to spend. And the vast majority of, at least my clients out there, are not concerned with leaving a bunch of money behind to their kids. They want to be able to spend the money that they've worked their entire lives for and know that it's never going to run out. So at the time of this recording, a 65-year-old couple can get a 7.1% payout rate. So $7,100 per year for every 100,000 that you fund the annuity with versus that safe withdrawal rate of 3.5%, again, which is $3,500 for every 100,000 you have saved. So $3,500 versus $7,100 from the annuity, that's 103% more spendable income. Unreal. But because this is not based on market gains, remember, risk pooling, mortality credits, law of averages, and law of large numbers. This is why an annuity company can guarantee you such a high payout rate for every dollar that you send to them. And remember, the income from the annuity is guaranteed for life. Now, I know there are some aggressive managers out there like Fisher who tell their clients they can take 5% out every year of their portfolio, which is a terrible idea, by the way. And I've had people tell me, well, you're not as smart as Fisher. I'm not claiming to be as smart as Fisher. All I'm doing is going by the standards in the retirement planning industry. Okay. So it's a terrible idea to take that high of a percentage out because, again, if this market goes down in the early years of retirement, you're going to be in a lot of trouble. But let's just go ahead and stick with that 5% withdrawal rate and say that's totally fine and totally safe. So that would be $5,000 for every 100,000 that you have saved for your retirement. And I'm even going to pretend that annuity rates have dropped drastically. And now that same 65-year-old couple can only get a 6% guaranteed payout rate, which would be $6,000 for every 100,000 they have saved. Even with a super, super high withdrawal rate from a managed portfolio and a super low payout rate from an income annuity, the difference is still 20% more spendable income. And again, the portfolio is not guaranteed to last you. The income from the annuity is a contractual guarantee, no matter how long you and your spouse live. Let's go ahead and we'll take this to the next level now because I've had some people tell me my advisor says he can make more money for me in the market. And okay, that's a very real possibility. But one thing that we have to consider, again, as always, what is the purpose of the money? Because if the purpose of the money is to provide income, we can very easily find out what the rate of return would have to be to make sure the same sum of money you put into annuity would have to earn you every year to make sure it didn't run out. So if we look at a portfolio that charges 1.5% in fees between the management fee and the fund fees, 1.5% is very, very common, if not on the low side. If we took that same $100,000, put it into a managed portfolio, and started withdrawing $7,100 per year, your money manager or whatever account that you're speculating in, whatever, it would have to earn 8.5% every single year with no losses, and that probably just isn't going to happen. Okay, and I have people tell me all the time, Marty, I'm not going to live to 100. And that's fine. I will plan to whatever age you feel comfortable with me planning to. But do you think it's a good idea to plan to at least 90? So in that same scenario, sending that $100,000 to a managed portfolio, even if that money was going to last you to age 90, withdrawing $7,100 per year, you would still have to get a 7.5% return every single year with no losses ever. And I don't care how good your advisors are, this just isn't going to happen on a consistent basis. And I'm not saying you shouldn't have money in the market. What I'm just telling you is that to get a consistent return like that with no losses ever, just isn't going to happen. And even if they tell you they can do that on averages, don't get me started on averages. I've made plenty of videos on that. But even if they tell you they can do that, they're never going to back that up with a signed contractual guarantee. So going back to the original objection of the annuity company is just giving me my money back. Yes, but isn't that the point of any investment? Yes, you're hoping to make some money, some growth, but I think the majority of retired people out there are just more concerned with the return of their money. So the annuity is allowing you to spend more money than you could ever spend from your managed portfolio, again, because we're entering the world of risk pooling, mortality credits, the law of large numbers, and the law of averages, which you just cannot do with a managed portfolio. And because you're getting a higher payout from the annuity, it takes less money to fund your income needs, which now frees up more money to go out and chase the bigger gains in the market. It's really a win when it's all said and done. We're not sacrificing opportunity for safety. What really are the best and worst case scenario with these two options? With the income annuity, your worst case is you die before all the money is paid back from the annuity, but then the remaining balance goes to your beneficiaries. Your best case scenario is you live beyond the money you put into the annuity. Now you're the insurance company's pocket, and we have a really good idea of what type of return on investment you would have to get somewhere else to ensure the money will last you 25 to 35 years. Your worst case scenario in a traditional retirement plan is that you run out of money. And now you're solely relying on Social Security for your income, or you're relying on friends and family or charity for anything above and beyond that. Your best case scenario with the managed portfolio is the market goes crazy high and you have a bunch of money left over, but you never got to enjoy it. It'll be great for your kids, but just because you're making a ton of money in the market doesn't mean you can just start pulling whatever you want out of that portfolio because of the unknown of what will happen to the market in the future. And again, I don't think most retired people these days have the goal of leaving a bunch of money behind. They want to be able to spend it and know it's not going to run out. And going back to our original quote, while you are in the decumulation phase of your life, spending money from your retirement portfolio, you should be more concerned with the return of your money than the return on your money. So everyone, I hope that helps put some things into perspective. And if you haven't watched my video series called 20% More Spendable Income in Retirement, you probably have a good idea of what I talk about based on these numbers that I showed you today. But I go through multiple case studies to give you a really in-depth look on what I do and how I do it. Then, after you get a chance to get educated in this area of income annuities, go ahead, take the time, and book a phone call with me to get all of your questions answered. All you have to do is go to atlasannuity.com, atlasannuity.com, and just book a short time to where we can talk. No pressure, no obligation, no opinions, no hype. We're just going to get your questions answered. And if you're enjoying this information, please do us a favor, like the podcast, subscribe to it, and share it with someone that you think could benefit from the information. So everyone, again, this is Marty Becker, coming to you with episode number 55 of the Atlas Annuity Podcast, wishing you all the best in your financial education.
We hope you enjoyed today's episode of the Atlas Annuity Podcast. All information presented is for educational purposes only and is not a recommendation to implement any tax strategy, nor is it a recommendation to buy, sell, or transfer any security or insurance products. Atlas Financial Strategies Incorporated is an insurance-only licensed entity, and any decisions to buy or sell securities should be discussed with a licensed securities advisor, and any tax strategies should be discussed with a licensed tax professional. Past performance of any strategies or products mentioned are not a guarantee of future returns. For any other questions or concerns, please go to www.atlasannuity.com.